Welcome to SB Talks. Today is Tuesday, April 21st. I am Vincent O'Neill and I am joined by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, today, Nick and I will discuss ongoing developments in the Middle East and ramifications for markets and investments, the outlook for central banks with the Fed and the RBA meeting over the next fortnight, as well as private credit back in the headlines. Welcome to all our listeners. So, Nick, it's been just under 3 weeks since we last recorded. That was just before the Easter long weekend. That weekend was obviously marked by some significant Truth Social posts that raised tensions in the Iran conflict. But quickly after that, we had the ceasefire. And off the back of that, we've certainly had some market relief. For example, we saw the S&P 500 breach 7,000 for the first time, hit a new high mark. Obviously, oil prices sliding back. But amidst all of that, the deadline on that ceasefire is rolling around, I believe, Wednesday night US time. We still have significant flashpoints in the Middle East. The Strait of Hormuz does not really appear to be open. In fact, it's probably increasingly tension and conflict in that regard. What has changed, dare I ask? With all that has happened, what has changed?
Not too much, really. I mean, I think they're talking. And
that's a big positive.
Yeah, that is a positive, and they've stopped fighting for the time being. How long that lasts remains to be seen. But I think, clearly the US is looking to de-escalate and try and get the Strait of Hormuz reopened, and the Iranians are looking for some kind of lasting peace and, potentially some money out of this.
Reparations, potentially.
Reparations. So there's reported to be talks starting again in Islamabad tomorrow. It's not clear whether Iran will send a delegation. They're sort of humming and hawing at the moment, but it looks like it might go ahead.
So the last round of talks went on for about as much as a day before U.S. delegation headed by J.D. Vance sort of declared, well, we haven't achieved our objectives, we're out.
Yeah.
Which is not typical, let's say, for how those negotiations usually would progress, albeit that's not unusual from what we've unfortunately seen in how the broader conflict has been handled. I guess I would reiterate your point before, where I think we do have confidence that the US is trying to find potentially an off-ramp, but Iran aren't going to necessarily make it easy for them.
No, they know they have the upper hand. I mean, to put it in context, the JCPOA, which was the Obama-era deal with Iran over its nuclear enrichment program, took 20 months to negotiate. So I think it's probably a bit unrealistic to think everything can be nicely wrapped up with a bow in a day or two. These things will probably take time.
And I guess what you'd hope for is, there's just a commitment to the ongoing discussions, and with that, a de-escalation in the conflict, and ideally the strait being reopened, albeit Iran are probably smart enough to know that is their real ace. Yeah. They're not going to play that too easily.
No. And I think the other thing that's complex is it's not clear who's calling the shots in Iran. Over the weekend, we've had the foreign minister say that the Strait of Hormuz was open, only for the IRGC to say it's not and to start attacking a few boats trying to pass through. So it's not clear who's sort of calling the shots after the decapitation of the former leadership team there. There could be some internal conflict going on, and it makes it very difficult for the US then to work out who they're negotiating with and whether that's the correct team.
And I think that's a really good call out because, as you said, when you have, such a large-scale wipeout of the previous sort of leadership, and we know that the IRGC is probably the real power within Iran, and certainly that's what the regime had put in place to try and defend itself, and we're seeing, them trying to continue to assert their dominance over Iran, but some cracks, which probably makes the whole process all the more complicated.
Yeah, but I mean, it's amazing the market turnaround.
Yeah, it really is, because we sort of sit here and we're telling not a particularly good news story necessarily. There's been some developments, but the market is almost like deal done.
Yeah, so we've had up until last night 13 consecutive sessions with the Nasdaq going up. That's the first time that's happened since 1992. And a 18% gain in the NASDAQ over that period, which is the strongest since April 2020, sort of coming out of COVID.
The market's working really hard to not be distressed by this. It's almost surprising.
Yeah. Well, I think I mentioned on a podcast, a couple of podcasts back, this is typical. Often you get this sort of shock, the markets sell off, and then, a few weeks later it bottoms and kind of recovers. And that seems to have played out exactly this time, Whether that's the last we see of the sell-off remains to be seen, but for now, markets are taking it all in its stride. It's in a bit of a holding pattern, and there is a renewed focus on the underlying economics, which I've discussed before, have been pretty good. Corporate earnings season in the US been pretty good, so people are now sort of turning their attention back to those things.
Yeah, we entered the year with a pretty good tailwind story with obviously this whole AI and the AI infrastructure piece behind it. So that hasn't gone away, and I guess worth calling out that the US is less energy dependent than energy import dependent than other parts of the world. They're essentially energy neutral, so they're probably not necessarily feeling it. While it is probably hitting their gas prices and is potentially hitting their consumer sentiment somewhat, it's not necessarily spooking their market as much.
No. I mean, you mentioned consumer sentiment. We had the University of Michigan consumer sentiment survey. It's the lowest on record. So
since the survey began?
Since the survey began, which I think was in the 1960s or something like that. So it's very low, very weak. So yes, the consumer's definitely feeling it.
Yeah, no, that's really interesting. I wonder how much of that is influenced by just the broader uncertainty in which they potentially are living in that country at the minute, with just the erratic, for want of a better phrase, sort of leadership.
Yeah, and of course, price pressures have been a sort of recurrent theme with the US consumer over the past few years, and it's now just got worse.
It's almost like they're somewhat giving up on that as a priority to try and the consumers are probably feeling it.
Yeah.
Now we do have, staying in the US, we've talked about Kevin Warsh's nomination to be the Fed chair, and we're expecting those hearings, I think, this week, and we've got a Fed meeting coming up next week as well, so a bit of action on that front.
Yeah, it'll be interesting. There's a hearing into Kevin Warsh's nomination at the Senate Banking Committee, but we've had one of the Republican senators from North Carolina, Tom Tillis, who said that he won't approve of Kevin Warsh until the Justice Department drops its investigation into Chair Powell.
Okay.
And that all the overspend on the Fed building. So this is maybe all a bit moot. I mean, they'll still ask him, his views on Fed independence, on the direction of interest rates, on the conflict in Iran and what that might mean for monetary policy, his plan to reform some aspects of the Fed. So there'll still be all of that. And of course, he has a substantial portfolio that's reported to be over $100 million. And there's not a lot of transparency as to what's actually in that portfolio. So the Democrats will probably be probing into that as well. So it'll be interesting to see what comes out of that.
We are sort of a theme, though, and we are seeing some of the Republicans breaking ranks as things begin to get more chaotic.
Well, Senator Tillis is not up for re-election, so he can be a thorn in the side of the Trump administration on his way out, and he's definitely trying to use his position to preserve Fed independence. So it's possible that Senator Kevin Warsh mightn't find himself at the Fed until maybe even later this year. It just depends on when the Justice Department drops that investigation into Powell, if they do.
Now, with, I guess, a few of the things we touched on in terms of the US economy and obviously the ongoing conflict in the Middle East, what's your read on the next week's Fed meeting?
That'll be nothing to see here. They've made it pretty clear that they're waiting just to see what happens with prices, inflation, unemployment. So they're in a bit of a holding pattern. So there's nothing priced. For the full year to the end of December, there's 14 basis points of cuts priced. So a modest chance of a rate cut later in the year. But yeah, there's not a lot of conviction around that.
It's wheeled back in quite a bit from where it would have been several months ago.
Yeah.
I guess the price pressures is taking a toll in that regard too.
Yeah.
We've got the RBA closer to home the following week, early May meeting. Different agenda, and it's the likelihood of rate increases. What are you seeing there?
Yeah, so we're about 75% priced for a rate hike on the 5th of May. So that'll be the third rate hike in a row if that gets delivered. Before then, we'll get on the 28th of April the first quarter inflation print, so the official quarterly one. It's expected to be another shocker, possibly another 0.9. So it was 0.9 last quarter, maybe another 0.9 this quarter for trim mean inflation. So still way too high.
Annualizing into the sort of the high threes.
Yeah.
Way out of band.
Yep. So that's not where the RBA want it to be, and they want to have more conviction that it's going to return to the midpoint of their 2 to 3% target range over, a reasonable time frame. I think at the moment it's in 27 or 28. It'll take another couple of years to get back there. So I think there's a good chance that they'll follow up with a rate hike. That said, there's obviously the conflict, what that's done to energy prices, what that will do to the consumer as a form of tax. Consumer sentiment in Australia is also very weak. Business sentiment's weak. So, there was a degree of, economic momentum coming into this year, probably a bit strong, which was what was causing some of those inflation pressures. So whether we see cracks in that maybe later in the year will be interesting. But for now, unemployment's still pretty steady at 4.3%. So the RBA probably will have to act, is my guess.
Yep. So watch this space, but potentially another move incoming there.
Yeah, and then possibly another one after that. So we'll
not a lot of great news for certain parts of the Australian economy. Certainly.
No, and then a budget that we'll get in May as well. So that will be interesting to see whether
the big talking point around that is what they potentially do on capital gains tax.
Yeah, they're in a difficult position because if they hand out subsidies to help cost of living, then that's fueling the inflation fire. So they don't really want to be doing that. And then, there's a lot of people calling for more longer term structural reforms around things like capital gains tax.
And the tax structure more broadly.
The tax structure more broadly. So, yeah, I'm not sure what we'll see out of that.
Government's in a bit of a tight position there to try and make adjustments. Very important, I'd like us to come back to a topic that we've discussed a few times on the podcast, but it's certainly in the headlines, and that is private credit. And we've talked about it previously, particularly with concerns around AI and the impact of AI on software and software business models that might have once existed and whether the margins are still there where they previously were. This appears to have particularly caught the attention of private credit investors more necessarily than private equity. What's your take?
I think it's a culmination of things. So there was that whole scare around Jamie Dimon's cockroaches comment late last year with a few sort of fraud-related bankruptcies that weren't necessarily in private credit portfolios, but it did scare people to think that maybe there's some hidden skeletons
in the credit market more broadly.
In the credit market more broadly. And then, we had that SaaS-pocalypse, which we discussed previously, where some AI tools scared people into thinking that a lot of the business models of software-related businesses were under threat and they could be disrupted. Private equity has been a big buyer of software-related businesses, and private credit has also been a reasonably big lender into that space. So I think all of those things had spooked investors who were tending to shoot first, ask questions later. And so we got elevated redemptions across the whole US private credit sector, particularly in those evergreen funds that allow investors to pull as much as 5% of the fund out per quarter. And in many cases, more than 5% was requested to be redeemed from those funds, and they had to be
Trimmed back. Yeah.
So that's what they call gating of those funds. I think it's, in our view, we've spoken to a lot of the managers that we deal with. There is no systematic problem. They're pretty relaxed with their software exposure. They've, in many cases, brought in third-party consultants to review all the names and make sure that there's not a lot of disruption risk. So I think it's, there's no fire there. There's people who are sort of saying, oh, there's smoke. There must be a fire. I don't think there is a fire. And if there is, it's probably more relevant to the equity owners of those businesses rather than the lenders. So I think, we're reasonably relaxed, but we're probably likely to see elevated redemptions for a lot of those products for the next few quarters.
Several quarters ahead.
Yeah.
But as an asset class, again, it's a very broad asset class, and let's not all lump it all into one bucket. But when you are being selective, and in terms of some of the managers that you endorse, you remain comfortable in terms of their investment thesis.
I do, yes. Yeah. And in many cases, they're very diversified. They have hundreds or even, as much as 1,000 different borrowers in their portfolio. So
across different sectors.
Across different sectors. Now, their software is, maybe 20% of some portfolios, but not all those businesses will be disrupted. And if they are, it will take years, in my view, and the view of the managers.
Well, that's an excellent summary, as always. Thank you very much, Nick. And thank you to all our listeners.